Target stock ticker TGT, is currently trading at $159.77 per share, and over the past year, the stock has dropped quite a bit. We can see it's down 27.13%, but year to date, it's actually jumped up just a little bit, up about 5.3%, but over the past month, down slightly, around 1.16%. Now, if we come over here, we can see the starting dividend yield is sitting at 2.73%, and that's something I want to take just a moment to start talking about. If we jump over to the dividend tab here on Seeking Alpha and look at this dividend yield, we can see the 4-year average dividend yield for Target sitting just below 2% at 1.99%. So a nice starting dividend yield, especially when you consider where it's been at over the past 4 years. But if we also look at this dividend history, this is a company that's been increasing dividends for 54 consecutive years. So obviously dividend growth is of huge importance to this company. And if we jump over to the dividend growth tab, one of the things you'll see is we have really good dividend growth over the past few years, especially for a company that's increased dividends for 54 consecutive years. Typically, when you look at a company that's increased dividends for that long, you're going to see lower dividend growth rates, but look at this 1-year dividend growth rate, 25%. That's unbelievable. And if we look at the 3, 5, and 10-year dividend growth rates, you can see we have 16.5%, 11%, and 11.61%. So for me, those are 3 major green check marks. If we look at that dividend yield, again, higher starting than normal dividend yield, great history of dividends, and then the dividend growth over the past few years has been absolutely phenomenal. So in this video, we want to answer one major question: is Target trading at a good value right now? And before we jump into my stock valuation spreadsheet, there's a couple more things that we do need to point out. Target has its upcoming quarter's earnings in just a couple of days, and if we look at the latest quarter's earnings, we can see they actually had really nice beats. They beat their earnings per share by about 49% and beat their revenue expectations by $660 million. But if you come over here and look at the upcoming quarter's earnings, one of the things you'll notice is the projected earnings per share is actually lower than last quarter's, and the revenue is projected to be lower than last quarter's as well. And here's what's scaring a lot of investors over the past 90 days. When we look at the earnings per share revisions, we can see this has continually been pushed quite a bit lower. And if we jump over to an article on Seeking Alpha that I was just reading, we can see the bottom line is investors are nervous about this upcoming earnings report. If we come down, we can see 21 of the last 24 analyst revisions are coming in on the downward side. Scroll down a little bit more, we can see JP Morgan lowered its price target to $175 due to concerns over margins and the earnings per share line. Now, that price is still higher than the current trading price for Target, but it is still a little bit lower than their previous price target. So in this video, we're going to be jumping into my stock valuation spreadsheet to see if Target's a stock we should consider buying or selling, or even just holding if we already have it in our portfolio. If you'd like to be able to download this spreadsheet, then you can head over to my Patreon page at the link in the description. But let's go ahead and come up here and plug in TGT and hit enter, and you can see all of this data is going to automatically load in. If we come right here and look at this 500-day change chart, you can see last year where we had a major sell-off in shares after their earnings report. They announced that they had way more inventory than they were anticipating, which led to a huge sell-off, and it hasn't recovered since then. Around then, it was trading around $230 per share, I believe, but again, it has not come close to that price range since that sell-off. Now, we've already talked about the dividend, but we haven't talked about the dividend safety. The payout ratio is currently showing 65.80%, so that is a little bit higher than I typically like to see it, but let's dig into that just a little bit more once again. If we jump over to Seeking Alpha, if we go to dividends and click on dividend safety, we'll scroll down just a little bit. You can see that trailing 12 months dividend payout ratio, according to generally accepted accounting principles, sitting at around 70%. The same is true for non-generally accepted accounting principles, around 70%. So yes, a little bit higher than I typically like to see it, but something that I think is even more important than your typical payout ratio is going to be that free cash flow payout ratio. I think that is an extremely important metric to look at, because at the end of the day, if your free cash flow can cover your dividend payments, then your dividend will be safe. And if you can continue to increase your free cash flow year after year, you'll find that the company can consistently increase their dividend payouts. And if we look right here, we can see their cash flow payout ratio only sitting at 25.7%. That number makes me feel way better about the safety of the dividend payments from Target. So let's jump back over to our valuation spreadsheet. We can see analysts currently have a target price of $180 per share, institutional ownership around 82%. Beta is sitting very close to 1, so the volatility will be pretty close to that of the market. But let's go ahead and jump into our first valuation, which will be Graham's valuation. This is a valuation model invented by Benjamin Graham in order to calculate intrinsic value. He was one of Warren Buffett's mentors, and he wrote The Greatest Investor investing book of all time, The Intelligent Investor. So we need to plug in our variables into this formula. We have our earnings per share, and you can see right here I'm indicating this is the forward earnings per share at 8.42. Obviously, we'll get new announcements in the upcoming quarter's earnings here in just a couple of days. But we're applying a lower growth rate projection than I've applied for Target over the past couple of years when I've analyzed this company, because it looks like the short-term growth rates have come down quite a bit for this company. So I'm projecting a growth rate of around 8, and then we have Y, which is the current yield on AAA corporate bonds. And at the time of this video, it's sitting at 4.3. So when we plug all of this into our formula, we come to an intrinsic value of around $129.24 per share. That lower growth rate projection is going to drive down this valuation a little bit, and also Y being higher than it typically is going to drive down this valuation quite a bit as well. So under better economic circumstances, I think the valuation we would get with this valuation model would be quite a bit higher, but those two factors definitely driving down this valuation. Now let's go ahead and move forward and look at our discounted cash flow analysis for Target. So what I've done is I plugged in the historical free cash flow so we can see our year-over-year growth rates. Over the past 6, 7, or 8 years, I've come to an average growth rate of around 19.85% for this company. So really good free cash flow growth during that time period. Obviously, a free cash flow growth rate of close to 20% is not going to be sustainable, so you do have to look at analyst expectations and dig into the company a little bit yourself. But once I did that, I came to a free cash flow growth rate moving forward of around 8%. I think that will be sustainable, and of course, that's going to help with the dividend payouts as well. But I applied that 8% free cash flow growth rate to the future free cash flows and to the terminal value, which is the sum of the future free cash flow past the year 2030. I then found the present value of those future free cash flows and added them together, added the company's cash and cash equivalents, which I do need to note, this has been halved since the last time I analyzed this company, and the total debt has risen a little bit as well. So that's really not a good sign overall for the company. Not very good liquidity, apparently short term with their cash position. But once you add the cash, subtract out total debt, you get the equity value, divide by shares outstanding, and we come to a discounted cash flow price per share of $197.16, quite a bit higher than that current trading price. Now, moving forward, let's look at our multiples valuation. And what we're doing is we're seeing how the market is valuing companies that are similar in structure using a price to earnings multiple. So you can see our comparable companies. We have companies like Walmart, Dollar General, Kroger, and Dollar Tree. We're taking their stock price, dividing by the earnings per share to get the price to earnings multiple. And the average price to earnings multiple for these companies sitting at around 23.54. So when we multiply that by Target's earnings per share, we come to an intrinsic value of $140.76. Moving forward and looking at our last valuation, the dividend discount model, this values a company based on how much they pay out in dividends and how much that dividend is increasing over time. So you can see I plugged in the quarterly dividend payouts over the last 4 or 5 years, so we can see how much they pay out each year. And this allows us to see our year-over-year dividend growth rate. So around 3%, but the past couple of years is where we have seen major dividend growth, 32.35% and then 20%. So that's an average growth rate of 14.63%. So pretty phenomenal dividend growth within the past couple of years. That's really going to bump up your yield on cost if you had previously invested into this company. But moving forward, I'm projecting a dividend growth rate of 6.25%, discount rate of 8.5%, and that gives us a dividend discount model price per share of $204 even. Now, what I typically say is whenever you project a dividend growth rate that's fairly high, such as 6.25%, you want to check that free cash flow growth rate, which we've already talked about. It looks like it's sustainable, and look at that payout ratio and make sure it's sustainable. We've already talked about that as well, showing 65.8%, but the free cash flow payout ratio is looking much healthier than that. So moving forward and looking at all 4 of our valuations, grams at 129, multiples at 140, discounted cash flow 197, and dividend discount model at 204. And when we average all 4 together, we come to an intrinsic value of $167.79. Current trading price around $159, but with a 10% margin of safety, you can see our acceptable buy price for this company sitting at around $151 per share, with a 20% margin of safety around $134.23 per share. Now, full transparency as always, this is a company I own in my personal dividend portfolio. If I blow this chart up just a little bit, you can see looks like my target position is right here. I'm up about 11.34% on this position. My average buy price is sitting at around $144 per share. I feel pretty comfortable with that. I really like the dividend with this company, higher than normal starting dividend yield, good history, and really solid dividend growth over the past few years. So I think if you do get an opportunity after they release their earnings report, if we see the stock jump down a little bit, it's definitely worth looking into more and see if it fits into your dividend portfolio. So with that being said, thank you guys so much for watching this video. If you'd like to be able to download the spreadsheet, then you can head over to my Patreon page at the link in the description. So with that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.